accounting treatment, issue of shares, forfeiture of shares. We have already seen that share capital denotes the amount of capital raised by the issue of shares. It is collected through the issue of shares and remains with the company till its liquidation. Share capital is owned capital of the company. It is the money of the shareholders, and the shareholders are the owners of the company. This total share capital is divided into small parts, and each part is called a share. Thus, a share is the smallest part of the total capital of a company. Call on a share. A demand made by the company on its shareholders to pay whole or part of the balance remaining unpaid amount on each share at any time during the lifetime of a company is termed as call on a share. When a public company intends to raise capital by issuing its shares to the public, it invites the public to make an offer to buy its shares through a document called prospectus. After reading the prospectus, if the public is satisfied, then they can apply to the company for the purchase of its shares. Each application form, along with the application money, must be deposited by the public in a scheduled bank. The company cannot withdraw this money from the bank till the procedure of allotment has been completed. In the case of first allotment, this amount cannot be withdrawn until the certificate to commence business is obtained and the amount of minimum subscription has been received. A point to be noted: the amount payable on application of a share shall not be less than 5% of the nominal value. Allotment of shares means the company has accepted the offer made by the applicants to take up the shares applied for. It is on allotment that a share comes into existence. Thus, the application money on the shares after allotment becomes a part of the share capital. The company may demand the balance amount which is due after application and allotment from the shareholders in one or many parts. They are termed as first call, second call, and so on. A word final is added to the last call. The amount of call must not exceed 25% of the nominal value of the shares. At least 1 month must have elapsed since the date which was fixed for the payment of the last preceding call. Also, a minimum of 14 days notice is given to the shareholders to pay the amount. When the shares are issued by the company in consideration for cash, such issue of shares is known as issue of share for cash. In such a case, shares can be issued at par or at a premium or at a discount. Such issue price may be payable either in lump sum along with the application or in installments at different stages. For example, partly on application, partly on allotment, and partly on call. The accounting procedure for the issue of shares for cash is given below. Issue of share at par. Shares are said to be issued at par when the issue price is equal to the face value. For example, a share of 10 rupees when it is issued for 10 rupees is said to be issued at par. Issue of shares at premium. When shares are issued for an amount more than the face value of share, they are said to be issued at a premium. For example, if a share of 10 rupees is issued at 15 rupees, such a condition of issue is known as issue of shares at premium. the difference between the issue price and the face value, that is 5 rupees. Share premium. It is a capital profit for the company. It shows a credit balance. It is shown on the liability side of the balance sheet. It is written under the heading Reserves and Surplus in a separate account called Security Premium Account. The Companies Act has laid down certain restrictions on the utilization of the amount of premium. According to Section 78 of this Act, the amount of premium can be utilized for 1. Issuing fully paid bonus shares. 2. Writing off preliminary expenses, discount on issue of shares, underwriting commission or expenses on issue. 3. Paying premium on redemption of preference shares or debentures. Issue of shares at discount. Shares are said to be issued at a discount when they are issued at a price lower than the face value. For example, if a share of 10 rupees is issued at 9 rupees, it is said that the share has been issued at a discount. The difference between the face value and issue price is called the discount. Share discount account shows a debit balance. It denotes a loss to the company, capital loss. It is in the nature of capital loss. It is desirable to write it off against any capital profit. Points to be noted. 1. At least 1 year must have elapsed since the company became entitled to commence business. It means that a new company cannot issue shares at a discount at the very beginning. 2. The company has already issued such types of shares. 3. Shares to be issued at a discount must be of a class already issued. 4. The resolution must specify the maximum rate of discount at which the shares are to be issued, but the rate of discount must not exceed 10% of the face value of the shares. For more than this limit, the sanction of the Company Law Tribunal is necessary. 5. The issue of such shares must be made within 2 months from the date of receiving the sanction of the Company Law Tribunal, or within such extended time as the Company Law Tribunal may allow. A quick glance at journal entries to be passed when shares are issued at par. A quick glance at journal entries to be passed when shares are issued at premium. A quick glance at journal entries to be passed when shares are issued at discount. The journal entries would appear as shown. Let us take an example of shares issued at par. Indo-Nissan Fabrics Limited issued 1 lakh shares of 10 rupees each on the 1st of April 2007. The amount payable on these shares was as under: 3 rupees per share on application, 3 rupees per share on allotment, 4 rupees per share on call. Pass the journal entries and prepare relevant accounts in the books of company. The journal entries would appear as shown. Journal entries when allotment money becomes due. When a company issues shares to raise capital, 1. It receives applications equal to the number of shares the company has offered to people. In such a case, journal entries would be: A. On receipt of application money, bank account debit to share application account, application money received for shares. B. On allotment of shares, share application account debit to share capital account, application money of shares transferred to capital account on the allotment. Two. Receives applications for less number of shares than offered to the public for subscription. A case of undersubscription. The company can proceed with allotment provided the subscription of shares is at least equal to the minimum required number of shares, termed as minimum subscription. 3. Receives applications for more number of shares than the number of shares offered to the public for subscription. This is a case of oversubscription. Option 1. 1. Rejection of excess applications and money returned. The company may reject the applications of shares in excess of the shares offered for issue. In this case, the application money received from these applicants is refunded to them in full. The journal entry made is as follows: share application account debit to bank account, application money on shares refunded to the applicants. 2. Excess application money adjusted towards sums due on allotment. Shares application account debit to share allotment account. Excess application money adjusted towards sums due on allotment. If the application money received on partially accepted applications is more than the amount required for adjustment towards allotment money, the excess money is refunded. However, if the articles of the company authorize, the directors may retain the excess money and adjust against calls in advance. The following journal entry is made: share application account debit to call in advance account. The adjustments of excess share application money retained as call in advance in respect of shares. Option 2. Partial acceptance of applications. In some cases, the company accepts the applications for subscription partially. Let us take an example. The Manjari Healthcare Limited has offered to public for subscription 20,000 shares of 100 rupees each, payable as 30 rupees per share on application, 30 rupees per share on allotment, and the balance on call. Applications were received for 40,000 shares. Applications for 10,000 shares were rejected altogether and the application money was returned. The remaining applicants were allotted the offered shares. Their excess application money was adjusted towards sum due on allotment. Calls were made and duly received. Make journal entries in the books of the company. Working. Total shares offered 20,000 shares. Total applications received 40,000 shares. Applications rejected 10,000 shares. That is, from an application amount of 30,000 shares, an additional amount received on 10,000 shares was to be adjusted for allotment money. Total amount received 30 rupees into 40,000 shares equal to 12 lakh rupees. Amount to be refunded 30 rupees into 10,000 shares equal to 3 lakh rupees. Balance amount equal to 9 lakh rupees. Amount due on share application is equal to 6 lakh rupees. Balance amount adjusted towards allotment is equal to 3 lakh rupees. The actual amount to be received on allotment, 30 rupees into 20,000 shares, is equal to 6 lakh rupees. Already adjusted from application is equal to 3 lakh rupees. Received on application is equal to 3 lakh rupees. Journal entries for the same would appear as shown. Let us take one more example. Bolivia Cars Limited issued 1 lakh shares of 10 rupees each at a premium of 4 rupees per share, payable as on application 4 rupees including 1 rupee premium per share. On allotment 5 rupees including 2 rupee premium per share. On call 5 rupees per share. Applications were received for 1 lakh shares and allotments were made to all. The journal entries would appear as shown. Shri Krishna Agrochemical Limited was registered with a capital of 50 lakh rupees divided into 50,000 shares of 100 rupees each. It issued 10,000 shares at a discount of 10 rupees per share, payable as 40 rupees per share on application, 30 rupees per share on allotment, and 20 rupees per share on call. The company received applications for 15,000 shares. Applicants for 12,000 shares were allotted 10,000 shares and applications for the remaining shares were sent letters of regret and their application money was returned. Call was made. Allotment and call money was duly received. Make the journal entries in the books of the company. The journal entries will be as shown. India Software Limited offered 50,000 shares of 10 rupees each to the public, payable as 2 rupees on application, 3 rupees on allotment, 2 rupees on first call, and the balance as and when required. All the shares were applied for and duly allotted. But Mukesh, a shareholder holding 200 shares, paid the entire balance on allotment. Make the necessary journal entries. The journal entries would be as shown. X Limited made its first call of 20 rupees per share on the 1st of July 2006. Zahir, holding 200 shares, failed to pay the call money. He could pay the call money only on the 31st of December 2006. The company charged interest at 12% per annum. Make the necessary journal entry for the interest charged by the company. Solution: the amount of interest due is equal to 240 rupees. Bank account debit 240 rupees to interest on call in areas account 240 rupees. Receipt of interest on calls in arrears. Let us take an example. ABC Limited issued 20,000 shares of 10 rupees each, payable as 2 rupees per share on application, 5 rupees including premium of 2 rupees per share on allotment, 3 rupees per share on first call, and the balance on final call. All the money was received except the first call money on 400 shares, which was received later on with final call. Make the necessary journal entries. Joint application and allotment account. These days, it is becoming a practice to open only one account in respect of application and allotment, and not two separate accounts. This is based on the reasoning that allotment without application is impossible, while application without allotment is meaningless, so that the stages of the share capital transactions are closely interrelated. Hence, from this point of view, share application and share allotment account appear more logical if combined account for application and allotment is opened. In such a case, the following 3 entries will be passed. A quick glance at journal entries to be passed when shares are issued at par. A quick glance at journal entries to be passed when shares are issued at premium. A quick glance at journal entries to be passed when shares are issued at discount. Calls in arrears and interest on it. If a shareholder makes a default in sending the call money on allotment or on any calls according to the conditions, the money not so sent is called call in arrear. The company is authorized to charge interest at a specified rate on calls in arrear from the due date to the date of actual payment of the allotment money or the calls. But if the articles of association are silent, Table A shall be applicable, which provides for interest at 5% per annum. However, the directors have the right to waive the payment of interest on call in arrear. Accounting treatment of calls in arrear. There are 2 methods of dealing with call in arrear. 1. By opening calls in arrear account. In this case, a separate account for calls in arrear is opened. If the amount of calls has not been paid by some shareholders, such amount is transferred to newly opened calls in arrear account. Thus, allotment and other call accounts will not show any balance, but the calls in arrear account will show a debit balance equal to the total unpaid on allotment calls, which will be shown as deduction from the amount of subscribed capital on the liability side of the balance sheet. The journal entries for the same shall be as shown. Without opening calls in arrear account, it is not necessary to open a new account for calls in arrear. In that case, the amount actually received from the shareholders is credited to the relevant allotment or call account, and the various allotment or call accounts will show debit balance equal to the total unpaid amount of allotment or calls, which will be shown as deduction from the amount of subscribed capital on the liability side of the balance sheet. The journal entries for the same shall be as shown. When a company accepts money paid by some of its shareholders for the call not yet due, Such amount is known as calls in advance. It may also happen in case of partial or pro rata allotment of shares when the company retains excess amount received on application of shares. Since the amount has not become due, hence it is a liability of the company. Therefore, it is transferred to the credit of a newly opened account called calls in advance account. In case of calls in advance, the company must pay interest at the rate prescribed in its Articles of Association. However, in the absence of interest clause in the Articles of Association, the provisions of Table A of the Companies Act will apply, according to which the company will have to pay interest at 6% per annum on its calls in advance from the date of receipt till the date when the call becomes due. Journal entries for the same shall be as shown. When any company allots shares to the applicants, it is done on the basis of a legal contract between the company and the applicant, which makes it binding upon the shareholders to pay the amount of allotment and calls whenever they are due. Now, if any shareholder fails to pay the allotment and or call money due from him, the shareholder violates the contract and the company is entitled to take its share back, which is known as forfeiture of shares. Forfeiture of shares means cancellation of allotment to defaulting shareholders and to treat the amount already received on such shares as not returnable. Procedure for forfeiture of shares. The usual procedure is that the defaulting shareholder must be given a minimum 14 days notice, requiring him to pay the amount due on his shares along with interest on it, stating that if he fails to pay the amount and the interest on it, the shares will be forfeited. In spite of this notice, if the shareholder does not pay the unpaid amount, the directors, after passing a resolution, will forfeit the shares and information will be given to the defaulting shareholder about the forfeiture of his shares. Effect of forfeiture of shares. Termination of membership. The shareholder whose shares have been forfeited lose all the rights and interest on those shares, that is, they cease to be a member, shareholder or owner of the company, and their name will be removed from the register of members. 2. Seizure of money paid. The amount already paid on the forfeited shares by the defaulting shareholders will be seized by the company and in no case will be refunded to the shareholder. 3. Non-payment of dividend. When shares are forfeited, the shareholder remains no longer a member of the company. Therefore, he loses the right to receive future dividend. 4. Reduction of share capital. Forfeiture of shares results in the reduction of share capital to the extent of amount called up on such shares. Journal entries for the same shall be as shown. Forfeiture of fully paid shares. Usually the shares are forfeited for non-payment of the calls, but at the same time, fully paid up shares can be forfeited in such cases as default in fulfilling any agreement between the members or on expulsion of members where the articles specifically provide for such details. Accounting treatment for reissue of forfeited shares. Issue of shares for consideration other than cash. There are instances where a company enters into an agreement with the vendors from whom it has purchased assets, whereby the latter agrees to accept the payment in the form of fully paid shares of the company issued to them. Normally, no cash is received for such issue of shares. These shares can also be issued either at par, at premium, or at discount. And the number of shares to be issued will depend upon the price at which the shares are issued and the amount payable to the vendor. Thus, to find out the number of shares to be issued to the vendor will be calculated as follows. Number of shares to be issued is equal to amount payable divided by issue price. The latest technology company limited offered to public subscription of 50,000 shares of 20 rupees each at a premium of 5 rupees per share. The amount was payable as under. On application, 5 rupees per share. On allotment, 12 rupees per share, including premium of 5 rupees per share. On first call, 4 rupees per share. On second and final call, 4 rupees per share. Applications were received for all the shares. Allotment was made to all the applicants in full. Ashima failed to pay allotment and call money on 200 shares held by her. Reshma was allotted 300 shares. She did not pay the call money. Their shares were forfeited. Make the necessary journal entry for the forfeiture only. Example of forfeiture of share and reissue. X Company Limited forfeited 200 shares of 10 rupees each fully called up, on which 7 rupees have been received and final call of 3 rupees per share remains unpaid. These shares were later reissued for 8 rupees per share fully paid up. Make the journal entry for recording the forfeiture and reissue of shares. Thus, to issue shares, a company follows a definite procedure which is controlled and regulated by the Companies Act and the Securities and Exchange Board of India, SEBI.